So what is asset allocation and how does it affect your investment portfolio? That's what we're going to be talking about today. Let's get moving forward. Hey everyone, welcome to Plan Ranger, where our goal is to provide you with informed insights and a reasonable approach for managing your personal finances. So we've done a couple videos here and there about stocks and bonds and, investing in general. But one of the main questions I actually just got a few days ago in me with a couple clients is, what is asset allocation? What does it have to do with my investments and why do we always talk about it? If you're looking for strategies to build a sound investment portfolio, then you absolutely cannot overlook the importance of asset allocation. I know it's not a very interesting, doesn't sound sexy or fun or anything like that, but it is quite possibly the most important decision that you're going to make when it comes to developing your own investment portfolio or understanding an investment portfolio that's been set up for you by somebody else, such as a professional financial advisor. You should be greatly concerned about asset allocation because it is probably the central driver for how your portfolio behaves from a risk and return standpoint. What that means is, all of the time that you spend researching things like, should I be in an actively managed fund or a passive fund, indexes, mutual funds, ETFs, all of those types of decisions that you think are having a really, really large impact on your investments and your portfolio are actually by far way further down the list than what you think. And way above any of those things is the simple question of what assets are in your portfolio in the first place. That decision trumps everything else, all the other work you're doing. So you really want to have a good hold for asset allocation and the process of how it affects your portfolio. In the event that you're new to investing, we should probably break down what an asset class is, because that term in and of itself might be kind of confusing to you. Let's start here. Let's take the houses on your street or in your neighborhood, right? Chances are the houses in your neighborhood kind of move in value up and down together somewhat. If there was a series of break-ins that all happened in your neighborhood or on your street, chances are all of the houses on your street are going to lose value similarly together, right? They're going to go down 3, 4, 5, 6%, all of them, because that neighborhood was affected by the same risk. On the other hand, if something great happened, all of your houses might go up in value over time, but they're going to kind of move together for the most part. It's not like one house is necessarily going to go up 25% and the house next door to that is going to go down 7%. They're in general going to kind of move together. They're exposed to the same types of risks and rewards. They share common characteristics. Versus, let's say, your house and a company like Tesla, right? What happens as far as those break-ins go in your neighborhood probably has very little, zero, zilch, nothing to do with what's happening to the price of Tesla's stock. Their stock is going to move completely independently of yours. They don't share any common characteristics. So when we're looking at an asset class, we're looking at a grouping of securities or assets that have similar characteristics as pertains to risk, reward, and then generally things like regulation and taxes. So for example, to kind of simplify this hopefully, the major asset classes that are generally referred to in the investment world are stocks, bonds, and cash. Now, more recently, there's been a trend to add some other primary asset classes like real estate and tangibles to that, and so you might hear people refer to that as well. But going back historically to the research of how much asset allocation has an effect, it was always stocks, bonds, and cash. Okay. Now, each of those, stocks, bonds, and cash, can be broken down further into other subcategories, subclasses. So if you got stocks, for example, we can look at company size, as large, medium, or small, and actually go further than that into micro or giant. So we've got company size as a factor where you can look at asset classes. You can also break it down based on the style, such as growth, blend, and large. So for example, if you were looking at Apple would be a large growth company. On the other hand, if you've got a utilities company, they might be a mid-sized value company. And so you've got all these different ways to break down asset classes so that you kind of understand the risk-reward relationship that pertains to that, right? Bonds can be broken down the same way. You can look at bonds and say, hey, look, it's a floating rate or is it a fixed rate? Is it a high credit quality or low credit quality? Is it like a junk bond? Is it short, medium, or long term? The duration of the bonds. Is it international or is it domestic? Is it municipal or is it corporate? There's all these different ways, again, that we can break down, bonds, just like stocks, into these subcategories of asset classes. And inevitably what happens is you get a beautiful pie chart. That's what, when you pull out your investment statement, if you're already an investor and you've got a decent portfolio, or, you've got a well-diversified portfolio, you're going to have a nice looking pie chart. And this leads to kind of the next point, which is when people talk about diversification, this is in general what most financial professionals are talking about. They're talking about not just, hey, I own 10 companies, 10 individual stocks or 15 or 20 individual stocks. That's a helpful step for diversification, without a doubt. But real deep diversification generally comes from segmenting asset classes. That's where you really start to see some gain in the realm of diversification, the benefits that it can provide as far as managing your risk and hopefully getting as much return as you can for the amount of risk that you're taking. The amount of risk you're taking should directly impact how your asset allocation is set up. So for example, when you go to meet with a financial professional, or if you open an investment account, you'll probably go through a risk questionnaire, right? To find out for the particular account that you're opening, are you conservative, moderate, or growth, or aggressive growth? And usually risk is broken down into, generally speaking, 5 categories. 1, 2, 3, 4, 5, or as it's more commonly referred as, conservative, income to moderate, moderate to aggressive, or sometimes called growth, and then aggressive growth being, obviously the most aggressive here, the riskiest. There are asset allocation portfolios out there that mirror these different risk profiles already. And so if we look at these different risk allocations, right, from conservative, moderate to aggressive growth, what would those look like? A moderate portfolio, one that's right down the middle, would actually be 60-40. You might think it'd be 50-50, but that's not actually the case. It's usually going to have a bias towards stocks. So it's going to be 60% stocks and 40% bonds. As you become more aggressive, you're going to, these kind of model portfolios, generally speaking, are going to add 20% increments of stocks. So, if you're at 60% for moderate, you're going to have 80% in a growth portfolio and 100% stocks, or basically the entire portfolio would probably be stocks if you were aggressive growth. On the other hand, if you wanted to become more conservative, so if you're moderate here at 60-40 and you want to be, I want to be a little more conservative than that. I don't know if I want that much risk. You would take 20% off. And then if you want to be very conservative, more of a preservation mindset, you'd go 20% lower than that. So you'd only have 20% stocks in your portfolio if you were conservative. The rest would be bonds and cash, generally speaking, bonds. And then if you were moderate to, conservative to moderate, that level 2 out of 5, you'd be 40% stocks and 60% bonds. So how risky you are as an investor should drive what your asset allocation looks like, right? And why does all this really matter to your portfolio? Why should you focus on how risky you are and things like that? Because asset allocation, when I mentioned back into the mid 80s, there was this iconic study that was done, article that was put out by Brinson, Hood, and Bebar, I want to say, 1986, that is called the Determinants of Portfolio Performance, where they looked at a wide variety of pension fund managers and yada yada. The premise is this: what the kind of conclusion that they reached when they looked at stocks, bonds, and cash was that over 90% of the variability of returns, in other words, the total range of returns that could occur in the portfolio, were attributable to the asset allocation of the funds themselves. Again, not talking about how great the investment managers were, this, that, or the other. Did they time the market right? Did they choose exactly the right stocks? It was the simple question of, do they have stocks there in the first place? Do they have bonds there? What percentages? What exposures are they putting in there? Really drove the variability, the range of potential returns, more than anything else. So again, when you're setting up your portfolio, when you're learning how to build a portfolio, this should probably be one of the things, if not the thing, right at the top of the list. Finally, one of the other factors that can kind of come into play with asset allocation are the topics of rebalancing and drift. We're not going to dig into those right now because those probably deserve their own time in the sun, so to speak. We'll cover those in another segment. But when you hear people refer to drift and rebalancing, that's kind of, they're referring to the connection here of asset allocation. What can occur as stocks and bonds grow at different rates, okay? That's all we have for right now. If you have any questions, please feel free to leave them down below in the comments. If you know anybody else who's setting up their own portfolio right now or struggling with the same problem, please share this video with them and help us help them. Click like, subscribe to join the Plan Ranger community. We'd love to have you as a part of it. Until next time, thank you for taking the time. We hope this helped.